Somewhere this year, a press release went out announcing the acquisition of a real estate portfolio worth roughly $500 million. Office towers, industrial parks, a few thousand apartment units spread across a handful of cities. One name sat at the top of the announcement: a firm, a founder, a face. The story implied, without ever quite saying it, that this person now owned $500 million of property. That implication is almost never true.
Not because the announcement is dishonest, because the word buy means something completely different once the number gets this large. At $500 million, almost nobody writes a check for the full amount. Almost nobody funds the deal alone. And in a very real sense, almost nobody owns the buildings at all. Not in the way you'd own a house with your name on a single deed and your money paying for every square foot of it. What actually happens is stranger, more deliberate, and far more interesting than the headline suggests. And once you understand the mechanism, you'll start seeing it behind almost every large acquisition you read about, not just in real estate.
Start with the assumption most people carry into a story like this. Somewhere, there's a person or a firm with $500 million sitting in an account. They negotiate a price, they wire the money, the buildings become theirs, the risk becomes theirs, and every dollar of profit or loss belongs to them alone. It's the mental model we use for buying a car, a house, anything tangible. Bigger number, same logic, just more zeros. That model breaks completely at institutional scale, and it breaks on purpose. At this size, a real estate acquisition isn't really the purchase of buildings. It's the purchase of claims on buildings, legal and financial positions layered on top of a portfolio of assets, each claim with a different rank, a different risk, and a different reward.
The actual property sits inside special purpose entities, SPVs, holding companies built specifically to contain it, often one entity per asset or per small cluster of assets, nested under a master holding company, which itself sits under a fund vehicle. What gets bought and sold isn't a deed, it's ownership interests in those entities, fund positions, equity stakes, partnership shares. You can hold a piece of a $500 million portfolio and never once set foot on a single property it contains, never sign a lease, never meet a tenant. That distinction isn't a technicality, it's the entire mechanism. Because once ownership becomes a set of layered claims instead of a single deed, you can slice those claims apart and sell each slice to a different kind of capital at a different price for a different level of risk. A pension fund and a hard money mezzanine lender have almost nothing in common as investors, but both can hold a legitimate claim on the exact same building at the exact same time through entirely different instruments with entirely different rights if something goes wrong. This layering isn't a modern invention. The underlying idea, senior claims paid first, junior claims absorbing risk in exchange for higher reward, goes back to how railroads and utilities financed themselves over a century ago. What changed is scale and sophistication. Structured finance techniques refined for corporate leveraged buyouts in the 1980s got imported wholesale into real estate over the following 2 decades. And the growth of dedicated private credit funds since the 2008 financial crisis, as banks pulled back from riskier lending, filled the mezzanine and preferred layers with a category of institutional capital that barely existed a generation ago. What follows isn't a workaround. It's the mature, standardized form this kind of financing has settled into. That's the capital stack, and once you understand it, the rest of the deal makes sense. At the bottom sits senior debt, the largest, cheapest, least risky slice. In today's lending environment, senior lenders will typically cover somewhere in the range of 55 to 65% of the portfolio's value. That's tighter than it used to be. Before 2022, 75% leverage on stabilized assets was routine. Higher rates, stricter debt service coverage requirements, and more cautious lenders pulled that back. Regardless, this remains the majority of the money in the deal, and it's the safest position in the entire structure. First in line to be repaid every month, first in line to foreclose if something goes wrong. On our $500 million portfolio, that's roughly $275 to $300 million, sourced not from the buyer's pocket, but from banks or dedicated debt funds simply lending against the value of the real estate itself.
Above that sits mezzanine debt, a smaller, riskier layer that fills the gap between what the senior lender will cover and what the deal actually needs. Mezzanine lenders take a second position, subordinate to the bank, secured not by a mortgage on the property itself, but often by a pledge of the ownership interests in the entity that owns it, meaning if the borrower defaults, the mezzanine lender doesn't foreclose on the building, it seizes control of the company that owns the building, a faster and legally distinct remedy. They charge accordingly, often somewhere in the low to mid-teens in annual return. On a stabilized asset, senior debt plus mezzanine can push total leverage towards 75, sometimes 80% of the deal's value. Above mezzanine, or sometimes instead of it, sits preferred equity. Technically not debt at all, but equity dressed in debt-like clothing. It carries no lien on the property, but it gets paid before common equity, after all the debt, and it typically makes up another 10 to 20% of the capital stack, priced in a similar double-digit range to mezzanine. What's left, the sliver at the very top, is common equity, the riskiest capital in the entire structure, first to lose money if the deal goes bad, last to get paid if it goes well. And this thin, dangerous layer at the top is what most people picture when they imagine buying the portfolio in the first place. In reality, it might represent as little as 20 to 30% of the total capitalization, and sometimes less. So who actually owns that top slice? Mostly, it isn't the person whose name is on the announcement. It's a syndicate of limited partners, pension funds, insurance companies, sovereign wealth funds, university endowments, family offices, who commit the vast majority of that equity capital. The sponsor, the general partner, the person running the deal, typically contributes somewhere between 1 and 5% of the total equity. Not 1 to 5% of the $500 million, 1 to 5% of the equity slice sitting at the very top of the stack. Do the math on our portfolio. If debt covers roughly 65 to 75% of the $500 million, the equity layer, preferred plus common combined, lands somewhere around $150 to $200 million. The sponsor's own cash contribution to that? At 3%, roughly $5 million. At 5%, closer to 10. On a $500 million acquisition, the person whose name is attached to the entire deal may have less money at risk than 3 or 4 individual limited partners writing separate checks into the same fund. That's not a loophole, it's the business model. Sponsors are, by design, capital constrained. Their job isn't to hold enormous amounts of their own cash in any single deal. It's to find deals, structure them, finance them, and manage them across as many transactions as their reputation and track record can support. Tying up hundreds of millions of their own dollars in one acquisition would defeat the purpose entirely. It would mean doing one deal instead of 10. The value they bring to the table isn't capital. It's access, judgment, and execution. And institutional investors pay for that, not for the sponsor's balance sheet. Which raises the obvious question. If the sponsor isn't funding most of it, how does a deal like this actually come together? It starts long before any wire transfer. A portfolio this size is usually sourced one of 2 ways. Either through a competitive broker-run process, an investment bank markets the assets to dozens of potential buyers, runs a structured bidding process, and price discovery happens through competition, typically producing a higher sale price for the seller and a tighter margin for the winning buyer. Or through an off-market relationship, the sponsor has existing ties to the seller, negotiates privately, often at a more favorable price, but with less market validation that the price is fair. Either way, once a price is agreed in principle, diligence teams comb through leases, rent rolls, environmental reports, title history, and deferred maintenance across every asset, months of work, and millions in third-party fees before $1 of the purchase price changes hands. Lawyers structure the holding entities, often layering in tax-efficient vehicles for foreign investors, while the sponsor simultaneously negotiates loan terms with lenders and raises the equity, usually through a private placement to accredited or institutional investors, which is part of why these opportunities rarely reach individual retail investors directly. This is where the sponsor's real product gets sold, not the buildings, the opportunity to participate in them. Institutional investors aren't buying real estate directly, they're buying access to a sponsor's ability to find, finance, and manage it well, at a scale and level of diversification they couldn't replicate on their own. That relationship gets written down in painstaking detail in a document called the Limited Partnership Agreement. Fees, promote, governance, reporting rights, all locked in for the life of the fund, often 10 years or more. Which brings us to the part of this structure that explains why anyone would want to be the sponsor in the first place, despite putting up almost none of the money. It's called the promote, sometimes carried interest, depending on who's using the term, borrowed from the private equity world and now standard across institutional real estate. And it's the mechanism that turns a tiny sliver of capital into an outsized share of the profit. Here's roughly how it works. Limited partners get paid first out of the deal's profits up to a preferred return, often somewhere between 6 and 9% annually for real estate. Below that threshold, the sponsor gets almost nothing beyond a flat management fee. But once the deal clears that hurdle, a catch-up provision kicks in. For a stretch of profit above the preferred return, the sponsor receives a disproportionately large share, sometimes 100% of it, until their total take reaches a pre-agreed percentage, commonly 20% of total profits generated so far. After that catch-up is satisfied, profits typically split on a fixed ratio going forward, often 80% to the limited partners, 20% to the sponsor. Put that next to the sponsor's actual capital contribution, again roughly 1 to 5% of the equity, and the asymmetry becomes obvious. A sponsor who put in $5 to $10 million of their own money can walk away with 20% of the profit generated on a deal built with $150 to $200 million of outside equity. That gap between capital contributed and profit captured isn't accidental, and it isn't hidden. It's disclosed in exhaustive detail in the partnership documents every limited partner signs, and it's the entire economic engine that makes being a sponsor worthwhile. Layered on top of that promote is a management fee, commonly around 2% of committed capital annually, which pays the sponsor regardless of performance. Together, the shorthand for this compensation structure is simply 2 and 20, 2% management fee, 20% carry above the preferred return. It's the same formula that built the modern private equity industry, imported almost unchanged into real estate. Now watch how that plays out when the deal actually performs. Rental income comes in across the portfolio, month after month. It pays operating expenses first. Taxes, insurance, maintenance, staff. What's left is net operating income, and that income has to move up the capital stack in strict contractual order. Debt service on the senior loan first, then mezzanine interest, then the preferred return. Only after all of that is anything left for common equity, and that's where the promote mechanics begin dividing whatever remains. Say the portfolio generates $28 million in net operating income annually, a little over 5.5% on the $500 million value. Debt service on the combined senior and mezzanine layers might consume 18 to 20 million of that. What's left, 8 to 10 million, flows to the preferred return first, then to the catch-up, then splits between limited partners and the sponsor. Every tier gets paid, in order, exactly as written. Take a firm we'll call a mid-sized institutional operator. 3 years into a $500 million multifamily and industrial portfolio, bought at a 5.5% cap rate, financed at 65% leverage. In year 1, rents land roughly on plan. Occupancy holds near 95%, and the preferred return clears comfortably. Limited partners collect steady, contracted distributions.
The sponsor collects its fee and a modest early promote. Quiet, mechanical, unremarkable. This is the structure working exactly as designed. The drama, when it comes, arrives from outside the building entirely. Then the Fed moves. A meaningful chunk of the mezzanine debt is floating rate, so its cost climbs directly with the market. 11% at closing, 15% 2 years later. At the same time, net operating income softens, vacancies tick up, rents grow slower than underwritten, a couple of major tenants don't renew. A third of the industrial assets sit in one metro that gets hit by a regional downturn, so the softening isn't evenly spread. It's concentrated exactly where the portfolio is least diversified. The waterfall still runs in the same order. Senior debt still gets paid first. Its position barely changed. That's the entire point of being first in line. But everything above it feels real pressure. Mezzanine debt service eats a much larger share of a smaller income stream. Coverage ratios drift toward covenant thresholds, sometimes triggering cash sweeps that pull money to the lender before the sponsor ever sees it. There's less left for the preferred return, maybe none. By the time cash flow reaches common equity, there may be nothing to distribute.
Nobody put that in the press release. The same leverage that let the sponsor control a $500 million portfolio with a sliver of personal capital is exactly what concentrates the loss when performance disappoints. Senior lenders stay protected. Preferred and common equity absorb the damage first, and often entirely. The sponsor may be forced to inject capital, negotiate an extension, or bring in a rescue partner to avoid a forced sale. Meanwhile, that flat 2% management fee often keeps flowing regardless because it's calculated on committed capital, not results. A sponsor can earn a meaningful living in a year where the limited partners, who funded almost the entire deal, see returns near zero. So why would any institutional investor ever agree to a structure built this way? Because the asymmetry isn't hidden, it's negotiated and offset. Sponsors typically co-invest their own capital alongside limited partners, so they lose real money too, even if less in absolute terms. A limited partner advisory committee, drawn from the fund's largest investors, holds approval rights over conflicts of interest and major amendments. And clawback provisions can force a sponsor to return promote already collected if early gains later turn into losses by the time the fund winds down. None of this erases the asymmetry, it manages it and gives limited partners real leverage if things go wrong. They accept the trade because what they're buying isn't just yield, it's access to deal flow, underwriting expertise, and diversification they couldn't replicate in-house. For a pension fund managing tens of billions of dollars, paying a structurally uneven premium to deploy capital efficiently through a trusted operator is often cheaper than trying to do it themselves. Eventually, every one of these deals ends the way it began, with a sale or a refinancing. The assets get marketed, existing debt gets repaid in the same order, senior, then mezzanine, then preferred, and whatever remains flows one last time through the waterfall to common equity, where the sponsor's promote captures its largest single payday of the entire hold. The exit is where years of structuring convert into realized profit, or where the equity holders finally discover exactly how little was left once everyone ranked above them had been paid in full. Step back far enough, and this isn't really a story about real estate at all. The same architecture, a small slice of true risk capital contributed by whoever runs the deal, layered financing ranked strictly by seniority, and a disproportionate reward for whoever assembles and manages the whole thing shows up almost everywhere large capital changes hands. Leveraged buyouts use nearly identical mechanics. Infrastructure funds buying toll roads and airports layer capital the same way. Private credit funds financing entire loan portfolios use the same seniority logic to price risk, a market now raising tens of billions of dollars a year, filling exactly the gap banks left behind. Once you've seen this shape once, you start noticing it everywhere. So what does it actually mean to buy $500 million of real estate? It rarely means writing a check for $500 million. It rarely means bearing the full risk alone. What it usually means is assembling a structure, debt from lenders who will never walk through the buildings they financed, equity from investors who will never manage them, and a thin, engineered position at the top that lets one party direct the outcome while risking only a fraction of the total capital involved. Ownership at this scale isn't a deed, it's a position in a waterfall, a negotiated claim on what's left after everyone ranked above you has already been paid, decided months before the deal closed, and rarely changed no matter what happens after. Understand that, and the next headline announcing a $500 million acquisition reads completely differently. Not as a story about how much money one person has, as a story about how little money it actually takes to control a great deal of it, and how carefully that control has to be paid for in risk, alignment, and trust, long before it's ever paid for in profit.